For larger, more costly projects like a major kitchen remodel or an addition of a new bedroom or bathroom that you can't simply finance with a credit card, you can actually take advantage of the equity in your home to pay for renovations. For anyone who isn't familiar, home equity is essentially a measure of the portion of your home that you actually own. More specifically, equity is the difference between the current market value of your home and the amount that you still owe on your mortgage. So for example, if your home's value is $400,000 and you still owe $250,000 on your mortgage, then your home equity is $150,000. And in this case, it's that $150,000 of home equity that you can borrow against in order to pay for your renovation. There are three main ways to leverage your home equity. There's a home equity loan, a home equity line of credit or HELOC, and a cash-out refinance. I'll be covering all three options, starting with the home equity loan and the HELOC, which are both secured loans, meaning that they're collateralized by the equity in your home. Being secured loans also means that they'll have lower interest rates relative to unsecured loans like personal loans. And the interest that you do end up paying may be tax deductible as long as you use it for home renovations. But also keep in mind that because these secured loans are collateralized by your home, if you can't keep up with the payments, then the lender can foreclose on your house, just like if you didn't make your regular mortgage payments. Even though home equity loans and HELOCs have similarities, they also have key differences that you'll have to consider when choosing which one to finance your project. The first difference is in the repayment terms. A home equity loan is given to you upfront as a lump sum, so you'll need to have a very accurate estimate of your renovation cost so that you don't borrow too much or too little. A HELOC, on the other hand, is a line of credit. So it acts more like a credit card in that you can borrow as needed up to a certain limit. This flexibility with the HELOC tends to work well for home renovations, which are known to be unpredictable in terms of the cost and timeline. With a home equity loan, you'll need to begin making fixed monthly payments starting immediately. Whereas with a HELOC, you only have to start making payments on the amount that you've actually borrowed once the draw period has ended. The draw period is just the period of time when you're allowed to borrow money from your HELOC account. And the draw period can be as long as 10 years. So in that particular case, it would be 10 years before you have to start making payments on the amount that you borrowed. But note that HELOC terms can vary quite a bit, so you need to shop around and find the terms that best fit your financial goals. The next difference is in interest rates. Home equity loans usually have fixed interest rates, while HELOCs typically have variable interest rates that can fluctuate over time. This means that with a home equity loan, you'll have the benefit of knowing exactly how much your monthly payments will be for the entire duration of your loan. With a HELOC, your monthly payments will vary depending on the current market interest rate, which can fluctuate depending on macroeconomic factors and the actions of the Federal Reserve. Both home equity loans and HELOCs have fees associated with them, such as closing costs and potentially even annual maintenance fees, so make sure that your renovation is big enough and necessary enough to warrant the added cost of these fees. Also be sure to compare the total cost of each loan, including fees and interest, to determine which one is the most cost-effective for you. The choice between a home equity loan and a HELOC will depend on your individual circumstances and financial goals. If you have a fixed price contract with your contractor that gives you high confidence in the final cost of the renovation, and the current interest rates are relatively low, then I might opt for a home equity loan so that you can take advantage of a low fixed interest rate. If you aren't sure exactly how much your renovations are going to cost, or you're tackling multiple projects with an unknown timeline where you don't need the entire lump sum up front, then I might go with a HELOC to give you that flexibility to pay as you go. Either way, it's important to consult with a qualified financial professional before making a decision and to carefully consider the pros and cons of each home equity option. And this is a great time to introduce this video's sponsor, Realm, who specializes in helping homeowners unlock their home equity to achieve their home renovation goals. Realm utilizes data from your local area to guide you through the entire renovation process. Their free dashboard makes it super easy to see how much home equity you have available for financing your renovations, and it's also a great place to find cost estimates in your area for the different projects that you might be considering. My favorite free feature is the Project Planner tool that shows how much a particular renovation project will increase the value of your home, which is really helpful if you're thinking about resale value in the future. Once you're ready to move forward with a renovation project, you can opt to pay a deposit for Realm's advisory service, where you'll get a personal advisor that will use data and local experience to help you make all the smart choices throughout the process, all the way until your project is successfully completed. So for instance, your advisor will help determine which projects are feasible within your local zoning and building code, and they'll provide you with personalized, detailed reports with accurate cost estimates and which projects have the highest return on investment based on your local material and labor costs. Your Realm advisor will also help guide you through the financing options, including how to take advantage of the equity in your home to pay for the renovation project. Once you decide on a project and how to pay for it, your advisor will identify several highly vetted contractors for you, and then they'll help you negotiate on multiple bids to get you the best possible pricing. After you sign with a contractor, you'll actually be reimbursed for that deposit that you made for the advisory service, and your advisor will continue to ensure that the project remains on schedule and also serve as a resource for you until the project is completed. I've included my affiliate link for Realm down below in the description, where you'll get $150 off any deposit you make for Realm's advisory service. Now, let's get back to the rest of the financing options. The third type of loan associated with leveraging your home equity is a cash-out refinance. A cash-out refinance is a type of mortgage refinancing in which you take out a new, larger loan than your current mortgage balance, and then you can use the difference between your new loan and your previous loan to pay for home renovations. For example, if you have a mortgage balance of $250,000 and you do a cash-out refinance for a new larger loan of $300,000, then you would receive $50,000 in cash that you can use to pay for home renovations. To be eligible for a cash-out refinance, you need to have equity built up in your home, similar to a HELOC and home equity loan. Note that most lenders won't let you borrow more than 85% of your home's value. The key thing when you're considering doing a cash-out refinance is the current market interest rate. The strategy of using a cash-out refinance to pay for home renovations is really only favorable to you if the current market interest rate is lower than the interest rate on your existing mortgage. If current interest rates are lower, then it's a win-win for you because you could end up with a lower monthly mortgage payment and also get the cash that you need to pay for your home renovation. However, if current interest rates are higher than your existing mortgage, you're probably better off looking at other financing options. And keep in mind that with any refinance, you'll be restarting the clock on the length of your mortgage, which means you'll be making payments for longer, and you could end up paying more interest over time. And there's also closing costs to consider, like loan origination fees, title fees, and appraisal fees. If you don't have enough equity in your home to borrow against, or you would rather just not use your home equity as collateral for a loan, then an unsecured personal loan may be a good option for your situation. An unsecured personal loan with a fixed interest rate could be the right choice for smaller renovations, as personal loans are often available in smaller amounts than home equity loans. A personal loan is considered unsecured because it does not require putting up collateral like your home or your car. Instead, it relies on your credit score, your income, and any existing debts to determine your loan terms and the interest rate. But because personal loans are unsecured, it means that their interest rates are typically higher than secured loans like home equity loans. And like all the other options I've mentioned so far, it's important to carefully compare the terms of the personal loan with other financing options, including the interest rate, fees, and repayment period, to determine which option is the most affordable for you. In addition to the no money down financing options I've described so far, there are special cases that can take advantage of government programs that offer grants and loans that help pay for home improvements in energy efficiency and accessibility. If you're planning a renovation along those lines, then it's definitely worth it to look into any local programs that may be available to you because they could save you a lot of money if you qualify. Also note that there are USDA and FHA 203K loans that enable low-income households that meet certain criteria to complete necessary home renovations. I won't go into more detail in this video, but if you think you might qualify for one of these loan programs, then you should definitely follow up with more research. There are construction loans available for larger home renovations as well, but they typically require an upfront down payment on the order of 10 to 20%. They could end up being a viable option if you do have some savings set aside. But since this video is focused more on no money down options, I'm not going to cover construction loans for renovations here. So I know that was a lot of information that I just threw at you, so feel free to drop a comment down below if you have any additional questions or if you think I missed something. And before I go, I just want to say that in an ideal world, you would pay all cash that you've saved up for these home renovations because it carries by far the least risk. All of these financing options I talked about in this video involve taking on debt, whether it's by borrowing against the equity in your home or using a credit card. And as you can see, there are pros and cons for every option. It's important to carefully compare your options before choosing a method of payment for renovations. And when comparing options, you should also consider the total cost of the renovation, including any interest or fees. In full disclosure, I'm not a financial advisor, so everything in this video is for informational purposes only. So please go and do further research to confirm the information that you've heard here in this video and consult with a financial professional to make sure that you're in a position to comfortably repay any loans that you take out for home renovations, because I would never want you to put yourself in a bad position. Remember, if you're interested in getting expert help on your next home renovation, check out my affiliate link for Realm down in the description. And with all that said, thanks for watching. Don't forget to like and subscribe for more weekly real estate and investing content, and I'll see you in the next one.